RBA cut cash rate to 2.5% from 2.75%. And I think the two key things for investors is that with the cash rate at 2.5%, you're now being rewarded at around the mid-range of the inflation targeting that the RBA have of that 2 to 3% band. So investors are now challenged to try and maintain the real value of their money or get a real rate of return. And what's driven this really has been investors having a flight to safety and being more conservative as a result of what happened during the GFC. So as a consequence, we've seen the household savings rate running at close to the high teens of disposable income, which is very high when you look at recent history. And so what this means is that risk premiums have risen for risky assets such as equities or credit. And so with the cash rate being closer to the middle of the inflation targeting band, investors will now have a bigger temptation, I think, to maintain a real rate of return. And I think that's one of the intended effects that the RBA are looking for investors to begin to take a bit more risk in their investments and to maintain that real return above inflation. So with these risk premiums being at pretty reasonable levels when you look at the historical context, credit's beginning to look like a very compelling investment. In terms of the cash rate falling, what this means for the credit quality is that whether corporates or individual borrowers who are borrowing now are able to borrow at lower rates. And this means they have more money to either invest or to employ people or to spend or to pay off their mortgages with. So from a broad credit quality point of view, it's a positive for credit quality. And so for investors, by investing in credit, not only are they able to take advantage of attractive risk premiums, they can maintain a real rate of return above inflation, and they can do it in an asset class where the fundamentals are actually improved as a result of these lower rates.